Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. No one likes to pay tax, so on today's show, we're going to show you how you can defer, reduce, and even completely eliminate tax through opportunity zones. The new rules are out, and we've got an update today on the Real Estate Guys radio program.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. With me, as usual, it's our financial strategist co-host, Russell Gray.
Hey, Robert.
You know, one of the hot areas of people's interest these days is opportunity zones. And we did a show last year when it just really came out, the new tax law, all that, and a lot of people very, very interested in it. And it's time for an update because we kept saying, the rules aren't out, the rules aren't out. Wait, and the wait is over.
Well, of course, we've seen this movie before because it's the same thing that happened with the Jobs Act, and we got all excited about that. You know, new law breaks Wall Street's monopoly. And there's something going on because that happened under the Obama administration, right? They created the Jobs Act, and inside of the Jobs Act was this reduction of the restrictions on purveyors of private placements to advertise to accredited investors. It used to be you had to be a member of the good old boys club. You had to be an insider, and it kind of opens it up. So we said, okay, this is exciting. This is going to give people a chance who are putting these deals together, syndicators, and we really accelerated our syndication mentoring program to help people take advantage of that because now it's going to be a lot easier to go find those investors. Now the Trump administration comes along and they put in this tax code. And the more I think about it, the more I look at it, the more I watch what's happening. Just like with the Jobs Act, I'm not sure Wall Street really understands what's happening because it really is a lot of Main Street now investing in Main Street, which of course is our mission in the syndication program. So it's really exciting to see this happening. And there's some things going on inside it. And I want to wait and hear what Mauricio has to say about it today because I do want to get the update and find out what's going on. But, you know, from what I've seen, it just seems to me that some of the things that people are concerned about are certainly real and you do have to be concerned, but they're not as concerning as you might think. So I don't want to say anything until after I hear what Mauricio has to say, and then we'll comment on that on the backside.
Well, I think the big picture, and just no investor left behind, certainly you should go back and listen to the show that we did last year, but let's just talk about what opportunity zones are, because what we're going to ask Mauricio to do is really give us the update, talk about the legal side of it and the new paperwork and the checklists and all that. But
I'll tell you what it is, Robert. It's a capitalist version of wealth redistribution. So there's one school of thought that says, hey, we're going to tax people, use the taxing authority to move money from the rich and put it where we want it to be. There's this other approach which says, hey, we're going to provide tax incentives to get rich people to voluntarily put their money where we want it to be. But at the end of the day, it's moving money from the haves to the have-nots, and it's doing it through enterprise instead of through social engineering. So you can say it's, you know, we're not making a political statement which way it should be or which way it shouldn't be. Certainly the country's standing on both sides of the coin. Right. And there's this big tug of war going on between the people who are believers in capitalism. And I think you can make a lot of arguments for and against because capitalism has become corrupt in a lot of ways, or that government is the solution. And I think you could make a lot of arguments for and against because government is clearly corrupt in a lot of ways. Anytime you consolidate power in a small group of people, whether they're corporate or whether they're government, there's going to be a degree of corruption. This type of legislation is pushing money through to the streets. And I think it's going to be really interesting to see how the marketplace really reacts to these tax incentives and if the money will in fact really move. And then once it's there, what will it really do?
Our friend and CPA Tom Wheelwright says if you want to understand what a nation wants its citizens to do, read its tax code. And he says the tax code is a series of incentives, and this is a great example of that. It's part of the new tax law. And the opportunity zones are just 6 pages within the tax law that basically give an incentive for folks that have appreciated capital gains. They bought something, it went up in value, and now if they sold it, they would normally pay tax. Instead, if they'll invest, according to the rules we'll learn about, in an opportunity zone, these are areas, physical areas. There's one in every state. There's many in most states and in Puerto Rico. And they are areas.
In some cases, they're entire states.
Well, it's areas that need help. Generally blighted areas and areas that need some gentrification, some work, some mass change. And so each governor of each state in the U.S. was tasked with this job of going out and figuring out where in their state were the areas that needed the most help, where private enterprise could step up, do some of the work, and get some of the benefits. So to your point, that's to encourage someone to do something with their money, as opposed to just raising taxes and having the government decide what to do with the money. So we're anxious to hear the update and find out what's new. When we come back, you'll hear from attorney Mauricio Rauld on the Real Estate Guys radio program.
Live nationwide, you're listening to The Real Estate Guys. Find out more at realestateguysradio.com.
Stop for a moment. Why are you listening to this show? Are you dreaming of a bigger, brighter financial future? More personal freedom to live life on your own terms? What if there was just one skill that could make it happen? There is. Sales. Robert Kiyosaki says every entrepreneur must be good at sales. It's true for investors too. Sales is how you attract money, people, and opportunities. Sales is the skill used to negotiate deals and lead your team. Sales skills are essential to success. The good news is, it's a learnable skill. The great news is, we've created a 2-day interactive workshop to teach those skills to you. Make plans today to attend How to Win Funds and Influence People, Mastering the Art of Financial Selling. For dates and details, send an email to sales@realestateguysradio.com or visit realestateguysradio.com and look under events. Gain the skills you need to succeed. Email sales@realestateguysradio.com or look under the events tab at realestateguysradio.com.
Forbes rated Memphis the best cash flow market in the nation. And our good friend Terry Kerr at Mid-South Home Buyers has been the premier turnkey rental property provider in Memphis for over 13 years. With an A+ rating from the Better Business Bureau, Terry has renovated over 750 houses. Real Estate Guys listeners have snapped up hundreds. Discover what these satisfied investors already know. Mid-South's properties are completely renovated with a 1-year warranty and a lifelong rental guarantee. They're affordable, well-managed, and easy to own. Perfect for beginning investors and veterans alike. Get in on the action. Contact Terry and his team via email at midsouth@realestateguysradio.com.
Hello, Robert Kiyosaki. Listen to the Real Estate Guys. They're wild and crazy, but they really know what they're talking about.
Welcome back to the Real Estate Guys radio program, heard every weekend on this great radio station and all the time at realestateguysradio.com. It is thrilling to talk about the legal side of real estate when you get this man on the show. Welcome back, our great friend and the anti-attorney, Mauricio Rauld. How are you?
I'm doing great, Robert. Thanks for having me back.
You know, we call you the anti-lawyer, but you really are a lawyer. You're a practicing lawyer, and you help people primarily with syndications. But, last year when we did the show on opportunity zones, it was brand new. It was this whole bunch of stuff we had to figure out based on the new tax law. And at the time, you said, this is going to be big. Let's go figure it out. And you've spent a lot of time between then and now, and we can't wait to hear the latest, the good, the bad, and the ugly on opportunity zones.
Right. Yeah, looking forward to it. Yeah, there's so much information out there that I just figured it would be easier to digest if we did it, the good, the bad, the ugly. But yeah, excited because there was a lot of uncertainty regarding the rules until a couple weeks ago. And then finally, we were supposed to get them last year, at the end of last year, but we had something called the government shutdown, which kind of delayed some things. But finally, a couple weeks ago, got some of the updates, which I think answered most of the questions. There's still a couple of, undecided and still a gray area, and I know they're coming out with another set of proposed regulations. There's actually a It's, I think, a 60-day, public reporting section now. So people are giving their comments about it, and they're still in the proposed mode, but they'll be finalized here in the next couple months. And like I said, they'll come out with some more guidance in the next probably two months from now.
We kind of saw the same thing with crowdfunding. You brought us the whole concept of that when the Jobs Act came out, and we started looking into it. And early on, when we first started talking about crowdfunding, we couldn't get any information. It was all coming soon, and that was delayed by over a year. But it finally came out, and that's finally a thing. So this is exciting because of some unique elements that aren't all to do about real estate, but a lot to do with real estate. So I guess just to keep people listening, let's start with the good.
Yeah, so the good is obviously the huge tax benefits from the opportunity zone. So there's really 4 benefits that you get when you are involved with an opportunity zone. So the first one, of course, is you get to defer the tax from whatever capital gains that you're coming out of. So for example, if you have a piece of real estate, or it doesn't have to be real estate, it can be precious metals, it can be stocks, it can be bonds, it could be your collectible car, it really doesn't matter. But if you take those gains, instead of paying the taxes on them, if you reinvest those gains within 180 days, into a qualified opportunity zone fund, then you get to defer that tax, not indefinitely, so not like a 1031, but at least for the next 7 years or 7.5 years as it stands today. It's up until December 31st, 2026.
Okay, so you're deferring the tax, which is great. It's not like not paying the tax, but you're deferring it into the future, which is exactly what we want to do as we plan our taxes.
Yes, so that's the first benefit, which in and of itself is pretty cool, especially if you're having some issues with a 1031 exchange. It's not a like-kind exchange. That's a nice benefit. The second one is if you hold that investment, the new investment now, right, the opportunity zone, if you hold that for a period of 5 years, you get a 10% discount on the capital gains that you would have paid on the original investment.
So not only is it deferred, but I pay 90% of what it would have been.
That's right. And the technicality, just to get not to get too technical, but basically your basis steps up 10%, and that's why you get that benefit. The third benefit is if you hold it for a couple more years and you wait for 7 years, then you get a 15% discount or an additional 5% for a total of a 15% discount, which again is nice because instead of, if you get $100,000 capital gains, instead of having to pay that on the entire $100,000, you're doing it on $85,000. So there's some tax savings there, which is appealing.
So instead of paying it when I sold the asset, as I typically would in that tax year, I'm deferring it either 5 or more than 7 years, and I'm not paying the full amount of tax as long as I hold it that long. That sounds pretty good.
Yeah, so that's kind of a discount that you get on the thing. And then the real benefit, or the one that at least they've been selling us on, is if you hold the new investment for 10 years or more, then the entire gain from that new investment is tax-free.
All right, so this is something you got to get your mind around. You're taking an appreciated asset. It could be a piece of real estate, or it could be stocks and bonds. Whatever it is, it's something that's gone up in value. And maybe the reason you're not selling it right now is because you don't want to pay tax. Well, by putting that money into an opportunity zone fund, and we'll talk about what it takes to actually have that be legal. Right. As long as you do that, then 1, you defer. You don't pay the tax right away. You're going to defer it. And 2, you get a discount on it. And then that actual investment where you put the money, if you stay in that investment for 10 years, whatever gain you see there is truly tax-free, not tax-deferred.
That's correct. 100% tax-free.
That's pretty cool. And of course, we talked about this a little bit at the beginning, but the reason that the government wants you to do that is opportunity zones are places where work needs to be done. And so to give you an incentive to use your dollars to get some of this work done, the government's going to let you defer, discount, and then take gains tax-free.
Right, because if you remember what our good friend Tom Wheelwright tells us, that the tax code is simply a series of incentives that the government gives us, and that's the way they kind of control what they want us to do or not through the tax code. And so this is something that the government wants us to do, which is invest money into geographical areas that are, hurting for cash, and they're dilapidated and they need an economic boost. And so one way to do that is to provide these huge incentives so that people would invest in places like Detroit, Michigan, which has really had a hard time over the last 10 years. and otherwise they wouldn't have invested in those areas, and now they will because of the tax advantages.
Right, especially because a lot of the money that we foresee coming into these opportunity zones hasn't historically been in real estate. It's been in other types of vehicles that have gone up a lot, and if they were not in a tax-sheltered vehicle, there's a lot of gain to be paid. You know, there's folks that are sitting on a big gain in the stock market, and they don't realize that gain till they sell. So again, check with your tax professional. But if I'm sitting on a big tax gain and I don't want to sell because I don't want to pay a big thing in tax, this could be pretty attractive.
Especially for you, Robert. I mean, you're a huge Apple stock owner, right? You always joke about how much Apple stock you have, and you've had that probably since the 70s or 80s. So you can probably sell that and have a huge capital gain. The other one, I know this is obviously a lot of the listeners are real estate investors, and they probably aren't too involved in the stock market, but precious metals is definitely one of those assets that I think a lot of the listeners are in, and that actually has a higher tax rate. If you end up selling it, it's got a special tax rate. So if you're sitting on gold and silver that you bought, 10, 15, 20 years ago at $300-400 an ounce, this is something that you can do. You can sell your precious metals if you want to, cash it in, and then defer that gain into an opportunity zone.
All right, so there's some of the good. Any more good?
Yeah, so we kind of touched a little bit upon it, but unlike a 1031 exchange, you don't need to be a like-kind exchange, right?
Yeah.
We talked about being able to go from a non-real estate asset into a real estate asset. So that's another good thing. The other one that's surprisingly good, and I'm sure Russell Gray will really appreciate this one, is that there's very limited government interference on this project. A lot of these other incentives, it's really heavily regulated. This one literally is a self-certification, meaning on your tax return, whoever's putting together the fund just checks the box and self-certifies that this qualifies as an opportunity zone fund, which is nice.
All right, so let's talk about kind of the two angles of this. One is you've got appreciated assets and you're looking to invest them somewhere and minimize your tax. And maybe you're not into real estate, or maybe you are. I'm guessing if you're listening to this show, you have at least a bit of an interest in real estate, but you're thinking, wow, I could sell my mutual funds and invest in some really cool deal that's revitalizing some part of our country. That's one. The other opportunity is for folks who want to put together these funds and solicit this type of investment. In the world of syndication, where we spend a lot of time, that's primarily where your practice is, of course, from the legal side. You've probably got syndicators that are chomping at the bit to get these opportunity funds up and running. So if I'm investing in one, I need to know what they're about. If I'm going to form one, I need to know what they're about. So you mentioned self-certify. That sounds pretty simple.
Yeah, it's literally check the box. There's a box that you check once you file your first year tax returns for the partnership. And if you're doing a syndication and you're the sponsor, you would just check the box and that's it. Now, there are certain things that happen during that hold period, that 5, 7, 10, that the government does check in with you every so often to make sure you're complying. But it's not like you have to go through like the SEC and go through a huge registration process or get an approval or anything like that. You can self-certify and you're good to go.
Now, the last show we did, we were still waiting on all these regulations and what was the final outcome of a lot of decisions. And because of that, no one could do anything. In fact, there were people who were saying, well, should I sell my gold now? But because of this 180 days you mentioned, most of the conventional wisdom, well, we don't have the rules yet. Is it far enough along that people could consider at this moment starting to liquidate some of those assets?
No, absolutely. I think it is, especially on the real estate side. So one of the other benefits of the opportunity zone is it's not limited to real estate, even though that's my focus and that's really what I'm stressing. But you can also invest in businesses. Now, the rules on that are a little bit more complicated, and that's where the majority of the uncertainty was, at least a couple of weeks ago. But now I would say we're at 95 to 99% there. So I feel comfortable. Not only do I feel comfortable starting or having my clients start opportunity zone funds, there's kind of a race to get it done. And the reason for that is, and that's kind of one of the bad things, is that in order to fully gain the benefits, you have to make the investment by the end of this year, because the gain gets deferred until December 31st, 2026. So in order to get that 7 years under your belt, you've got to have it done before December 31st of this year.
So you would have to liquidate your asset and invest in a fund before the end of this year if you wanted to get that full 15% step up in basis so that you could defer as much of your tax possible.
Correct.
If you missed this year, you could still go for the 10% in the 5 years.
Yes.
And either way, you need to hold the investment you invest in 10 years to make that tax-free.
Correct. Absolutely correct. 100% correct.
All right. So there's the good. Let's talk about some of the bad, because it's not all good.
Yeah, the main quote unquote bad is that there is a substantial improvement requirement.
Yeah.
Which means if you buy a piece of property, unless it's what's called an original use, which most of the time in our world won't happen, but we can get into that if you want, you are required to essentially put the same amount of money that you purchased the property in renovations, because that's what the government wants. They want economic activity. They want you to improve the properties. So there's a substantial improvement requirement. Now that only applies to the improved property. So it only applies to the vertical construction, the actual property. It's not on the land. So if you buy a property, let's say for $1 million and 20% of that is the land and 80% is the building, then you'd only need to invest $800,000 in order to do that.
Well, and part of the thinking here is it's not designed to just have you go buy an operating apartment building and now you've got all these tax benefits. It's really designed for folks to put private capital to work to revitalize some of these areas. And typically, you might take an asset that needs a lot of work, a lot of deferred maintenance, maybe a change in use, change in zoning even, and you're going to have that CapEx, those capital expenditures to get the property up to a point where it makes sense as an investment. But it's important that you draw that distinction. It doesn't work if I just want to buy and hold a bunch of houses.
No, there's actually there are some exceptions to that. One of them, for example, that just came out as part of the updates is if you purchase a piece of property that's been vacant for the last 5 years, then you don't need to substantially improve that property.
Okay, although you can follow that logic, and likely if it's been vacant for that long, it's going to need some work.
Right.
Maybe not the equal amount of what you paid for it,
right.
but okay, that would make sense.
And then the other thing to keep in mind, it does have to involve an active trade or business. So for example, you can buy a piece of raw land and you can develop it, and that would actually constitute an original use because by the time you're done with the building, it's going to be the first time you've actually put it into the market, so that works.
Well, and anyone who's done development knows that you're going to easily spend more than the cost of the land to develop the project.
But you can't land bank. So you can't buy a piece of property and hold it for 5 or 6 or 10 years and then sell it and get the capital gain, because you have to have, it has to be an active business or trade. The whole idea is to put money into the economy. But there's still some gray areas. I mean, one of the things that came up was, what if you buy a piece of, you buy 100 acres of land, and in order to accomplish the active trade part, you put a little hot dog stand on the corner or something, or a lemonade stand or whatever, and say, hey, look, I've got an active trade or business now, and therefore I'm eligible for the tax benefits at the end. So they're still looking at again, anytime you have a brand new regulation, there's going to be so many questions that over time they'll get answered either in subsequent releases or Q&As or some guidance that we'll get from the Treasury Department.
Okay, so we could call that bad, that you've got to spend whatever you spend on the improvements, again, at least that much in order for this to hold water. But I think it kind of is in the spirit of the thing. So going into it, that's what the Opportunity Zone is all about. It's an opportunity to improve an area and properties within that area. So got that. Any more under the bad category?
No, I think that's it. I mean, I think most of the listeners and most of my clients, they're going to go in and probably either purchase an existing property that they want to renovate anyway, which will put the substantial improvements, or they'll buy raw land and develop it. And those are probably the two most common. And either way, you're going to be putting some money into it. So I think that's probably the bad. Although the question becomes whether the ugly is really just bad on steroids or just bad.
Well, hold that thought, because we come back, we're going to talk all about the ugly. Our guest is Mauricio Rauld. He's an attorney that helps folks find and vet and put together real estate syndications. We're talking about opportunity zones. Next, we'll play real estate trivia. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
It's Robert Helms. Thanks so much for listening to the show today. I want to personally invite you to come see an amazing real estate market that combines excellent cash flow, offshore diversification, and what we affectionately call lifestyle investing. Come join me from July 5th to 8th in the beautiful country of Belize. The Real Estate Guys have been bringing investors to Belize for more than 13 years now, and our discovery trip is designed to show you the market like nobody else can. Sure, Belize is breathtakingly beautiful, the people are wonderful, and wait till you taste the food. But the real opportunity is the real estate investment potential. 2018 was the biggest year in tourism Belize has ever witnessed, and this year is starting off strong. How does that translate to real estate investment? That's what you have to come see. There's all types of opportunity in Belize when it comes to real estate, including both long-term and short-term rentals, commercial and retail triple net properties, business opportunities, land acquisition, development, agriculture, and more. And as the only country in Latin America with English as its official language, it's easy to understand the law. Property rights are strong, and contracts are in English. And at Ambergris Caye, a unique situation exists where demand for rentals continues to outstrip supply, creating a compelling environment for investors. So come see for yourself. Join me July 5th through 8th in Ambergris Caye, Belize, as we study the market, learn about the sustainable drivers, and tour lots of beautiful real estate. And like all of our field trips, there are no properties for sale during the weekend. Rather, you'll meet lots of local providers that will help educate you about the market so you can follow up with them after the trip if the market's interesting to you. But that ball's in your court. You'll receive their contact details, but they won't receive yours unless you give it to them. You've heard about Belize and the Real Estate Guys for all these years. Now come see what all the excitement is about. Plus, we'll have lots of time over meals and activities to talk about all things real estate. To get the details, go to the website at realestateguysradio.com and click on Events, where you'll find the Belize Discovery Trips. Once you register, you'll get information about our group hotel rates as well as travel details. So join me in Belize, July 5th through 8th. It's a beautiful country with lots of amazing possibilities, and the only thing missing is you. Go to realestateguysradio.com under Events. I look forward to seeing you in beautiful Belize.
Hi, this is Lawrence Yun, Chief Economist with National Association of Realtors, and you are listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. We're talking with attorney Mauricio Rauld about opportunity zones and some of the great benefits for both passive investors and active syndicators. Before we get back to that interview, it's time to play Real Estate Trivia, your chance to win a prize by knowing today's Real Estate Trivia question. In just a minute, I'm going to ask you a question that has something to do with real estate, and as soon as you know the answer, you're going to send off your best guess to trivia at realestateguysradio.com. The first person with the right answer is going to win a copy of CPA Tom Wheelwright's great book, Tax-Free Wealth. It's the updated version that includes the new tax law. That can be yours if you know today's real estate trivia question. Last week on the show, we were talking about market metrics, and we asked this. The television show Full House ran for 8 seasons, with the Tanner family becoming a TV staple. Where is the actual house that was used for the exterior shots on Full House? Well, the house sits on Broderick Street in Northwest San Francisco. Here's our real estate trivia question for this week. With summer coming up, people are going to be traveling around the United States to seek out fun and awesome places to discover. Here's our real estate trivia question. Name the least visited state in the U.S. Yeah, of all the U.S. states, which is the one that people visit the least? If you want to guess, or maybe you know, send your best guess to trivia at realestateguysradio.com. Include your name, your mailing address, and the answer to the question. And if you're the first one to get it right, you're going to win a copy of Tax-Free Wealth by CPA Tom Wheelwright. That's today's real estate trivia question. We're talking about opportunity zones with our good friend and regular contributor, Mauricio Rauld. And Mauricio, we talked about the good part of the opportunity zone opportunities, the bad, and now let's talk about the ugly.
The ugly, and this is a lot of it is personal opinions, to be honest with you, but one of the things, especially for my clients who are syndicators, it's obviously a great opportunity for syndicators because it's such a great benefit for the investors that they're able to sell their investment a lot easier because you can tout the tax benefits. But if you're the syndicator, you don't get the tax benefit for the carried interest part. So whatever your sweat equity is, let's say you do a traditional syndication, the investors put in the money, you put in all the work, and you split everything 80-20, for example. The investors who get the 80%, they'll get all the tax benefits, but your 20% profit when you sell this building in 10 years and you realize basically your basis was zero and whatever cash came in is your entire profit, you're going to pay taxes on that. You're not going to be able to defer that because, again, the whole idea is that you've taken money from somewhere else and you've deferred the gain. So that's just something to keep in mind from a syndication standpoint.
Well, I think that is pretty ugly because one of the tenets of syndication is if I'm the passive investor, which most people are, I want my promoter, my syndicator, the person running the project, to have the incentive to be excited about the deal. And if I'm the only one excited about the tax benefits and not the syndicator, okay. But again, I think to your point, a lot of the syndicators that we know are considering this not because of the tax benefits, but because of the opportunity to court capital from a completely new and different source. If I'm a real estate syndicator, then I'm talking to folks who may be investing in houses and strip malls saying, hey, it'd be a lot easier and more passive to invest with me. They already understand real estate. They already get, adding value to properties. They got that part down. Opportunity zones now give us a chance to go to a whole new category of investors, someone who's only been in the stock market or only been in private equities or metals or collectibles, who has avoided selling because they didn't want to pay the tax.
Right.
Now these very syndicators are able to go to them and say, hey, here's something you might want to consider that is huge for you, and what it does for the syndicator is fund their deal.
Right, exactly. And the tax tail, is really appealing to a lot of people. Like some people may not be interested in purchasing real estate right now, for example. Maybe some people say, hey, we're kind of late in the economic cycle. It doesn't make sense. I'm a little worried. But man, with all these tax benefits, that kind of offsets whatever risks you have. In addition, this is a long-term play. It's a 10-year plus. So you figured you'd probably go through at least one, if not two, real estate cycles before it's time to sell anyway. So,
one of the things longtime listeners will know from listening to our program is we always talk about real estate investing is something that the powers that be, the banks, the governments, the tax authority will come to our rescue. That's how important it is. And we've seen that happen before. And this is a case of already we're seeing that this makes sense for a lot of reasons. This was done in conjunction with the governors of each state. And the IRS has a big hand in this, obviously. So you got to think that if I'm going to invest in something, they're certainly not vetting every operator and they're not guaranteeing returns, but it is a system that they're putting considerable time and energy into to let people know about. So just as an investment point of view, nobody has a crystal ball. But to your point, 10 years from now might look different than 3 years from now.
Right. No, absolutely. And so I think that mitigates, and again, that's why I think for syndicators it's attractive, which is why I wanted to get ahead of the game here, because I had a lot of clients calling me excited about the opportunity zone, but we just didn't have all the information to go. But I think now we do, and so it's time to get cracking.
Just after the first of the year, we had Tom Wheelwright on the program, and of course that was one of the things we wanted to ask him about. We'd had him at several events talking about the new tax code, and it's very good for real estate, and maybe not for everybody, but certainly for real estate investors. And so we said, hey, what about opportunity zones? And his answer was, oh my gosh, it could be amazing, but again, not everything's in. And again, that was before it was. Now that it is, we will start to see these funds roll out. I mean, there were already people that were lining up investors saying, don't liquidate yet, but be ready to. Right. So what happens if somebody has some sort of investment and they want to sell it based on this? You mentioned the 180 days. From the time that they sell it, they have 180 days to put it into the fund. Are there any more rules about that?
Yeah, so actually you get a little bit of a break. So if you own the investment in your personal name, if it's just your investment and you sell it, then yes, you've got to put it in 180 days.
Okay.
But if you own an investment through, let's say you have a syndication, like you're in a syndication or you're in another partnership in another company, right, that you own shares, and that company sells the properties, then you actually get to extend the 180 days a little bit more, and it becomes the end of the year for that particular year. Because what happens, like if you sell property in May, you may not get your K1s until the following year in March of next year, and at which point you've obviously way blown your 180 days. And so the IRS or the Treasury Department has recognized that and has given you till, if that's the scenario, till the end of the year of the calendar year to make that election. So even if I sold the property now in May, the 180 days would start on that date. So you're covered when by the time your K1s come out for the following year.
Well, now of course that's not true for 1031. It is 180 calendar days, and it doesn't matter if it's a holiday, it doesn't matter if you're on vacation, right? If that time comes and goes, you've blown your exchange. With a 1031, there's what's called boot, meaning I don't have to put all of the money forward, but if I do take some, it's going to be taxable. Is that the same thing here?
Yeah, exactly. It's the exact same thing. So you can take some of the money off the table, but actually it's a little bit better, because if you take your original basis off the table, you're not going to pay taxes on that. So the gains only apply, maybe I should have said that at the beginning, all these benefits only apply to the capital gain, right? So if I put in $100,000 and I get back $200,000, it's only that $100,000 that's going to be eligible for, I mean, I can invest the entire $200,000, but only the $100,000 is going to be eligible for the deferment. And the same happens in terms of taking it away. So if I take $100,000 off the table, right? I'm not going to pay tax on that because that's just a return of my principal.
Okay.
Right? As opposed to in 1031 exchange, if you did the exact same scenario, you're going to pay the tax. So there is that benefit. And then the other benefits are, in terms of the fund anyway, we were talking a little bit about the fund. I still have a couple more ugly things to discuss. But the other thing to keep in mind is that you have a reasonable time. We have a reasonable time from the time we raise the money into the fund to actually deploy it. Because there's a substantial asset test, which means 90% of your fund needs to be located. The assets need to be located in the opportunity zone. But when you're raising capital, you first of all, it may take you a while to deploy. Like, at what point are you violating that 90% rule? And so the IRS came out with guidance and saying, if you've got 6 months to deploy the investment. So now a syndicator doesn't have that pressure of having to put the money to work the day after it gets raised or what have you. They've got a 6-month window. So,
which is good news for syndicators, because typically that's the case. If you think back to 1031, we're drawing a lot of similarities, because real estate investors typically understand 1031s, and the reason to do that, to defer the tax. And it's a great tool. This could arguably be a better tool. I guess we'll find out when the dust settles. But if I've got a property, say, and the basis is whatever it is, and I'm going to take my gain and put it forward and so forth, it sounds like I am still going to need to work with my tax professional, like you would with the 1031, just to make sure, especially since this is so new. So I've also wondered, who do you call? I'm guessing it's not the IRS, probably a tax professional or an attorney that has studied this.
Yeah, so I think you need two. Yeah, number one, you need obviously your tax professional, because this is a tax matter and there's a lot of forms to check. And even though it's self-certification, you've got to make sure you're doing the proper check in the box, and you've got to make sure you're following the rules in terms of the hold periods and having 90% and whatever, all these rules. And you need the attorney, because the attorney knows, at least if you're putting together the fund, which, by the way, it has to be in a fund, right? You can't do this individually. You have to put it in some kind of an entity. It doesn't have to be a syndication, but it has to be a partnership. So you need at least two or three people to do it. But you obviously need an attorney to make sure it's structured properly, and making sure the investment itself is eligible. I'll give you an example. Like on the business side, I know we haven't talked too much about the business, but the businesses are eligible, but there are certain businesses that are not eligible for the tax return. These are called these sin businesses. So, and for some reason, country clubs and golf clubs are in there, but liquor, you wouldn't be able to buy a liquor store and take advantage of the or a massage parlor, or these whatever the government considers these sin businesses.
What about a cannabis dispensary?
That's a good question. That's an excellent question. I'm guessing since it's illegal at the federal level, it's probably going to be counting it as sin. But so that's that.
So you want to know that for sure before you approach it. Now, I do want to clarify one thing about the timing. You have the 180 days as the investor. If I heard you right, I've got to get it into the fund in that 180 days, and given the tax year, maybe a little bit more. Is it after that the syndicator has another 6 months to put it to work?
Correct. Yeah. The money's now in the fund, and it's a qualified fund. It's self-certified. So, we're going to go. But at that point, when the money's in, there's no investment yet, right? The plan is to go buy a piece of property. They've probably identified a property, but you haven't necessarily closed on it. So this gives you time to actually close the deal. It sometimes takes 2 or 3 months to raise the capital. And so, the first people that put in the money, you're not going to be deploying that right away. And so they gave you, they initially said it had to be a reasonable time, and, nobody knew what that meant. And now they've clarified that it means 6 months.
So it sounds like there's a lot of good, there's a little bit of bad, and there's some ugly. What are some of the other ugly parts of this?
The other ugly part for me is it creates an artificial demand. Right? So number one, it creates an artificial demand, which means people are investing in properties they otherwise would not have invested. Right. And they're essentially letting the proverbial tax tail wag the dog, right? And so you just got to be careful, and you've got to make sure that the investment stands on its own merits, right? The other issue I think I see, and this is probably one of the reasons people are rushing to get it done sooner rather than later, is that because it's an artificial demand, you're going to be overpaying, right, for the property.
Potentially, yeah.
Potentially. And I think at some point it's going to adjust. You're going to pay so much more that at some point the tax benefits may not quite make sense. And at some point you're going to reach that level. So that's why I think a lot of people are trying to get in early, because the people who get in first are going to get the properties at the right price. At some point when the prices go up, you're going to say, look, I'd like to buy this piece of property in Detroit because for the tax reasons, but it's so much more expensive that it doesn't make sense. And so some people are arguing that instead of investing in opportunity zones, you actually invest in the periphery of the opportunity zone, because that's now kind of the path of progress, and you're going to see money flowing into a particular area. invest outside that area, you don't get the tax benefits, but you get a much reduced price. So the same property that costs you $100,000 in the opportunity zone may only cost you $70,000 outside the opportunity zone. So.
Yeah, that's actually one of the things we talked about when we recorded the show last year on this subject, is that anytime you study a market and all of a sudden capital's coming in and business is coming in, there's going to be that effect in the surrounding area. If it's, a big area where they're doing manufacturing and construction types of installs, which is what's needed in some of these areas, then maybe the play is, housing on the other side of town or nearby, but not in the opportunity zone. So it's something to think about. Yeah. But I hadn't thought about the part, and then you got to wonder if the government did, right? The government drives the incentives to stimulate behavior. They want private investors to help in this area, so they give us a tax benefit. But because of that, now folks come along and they're like, well, last year this property was cheap, but now I'm going to charge a premium because I know why you're buying it.
And there's a higher demand. There's more people. Last year nobody was making any offers on this building, and now you've got 3 or 4 or 5 people because they want the tax benefit. So
now there's one more that I see as potentially bad or ugly. I don't know how, and it's just this. A lot of times when folks invest in real estate, they want as close to certainty as they can get with the length of their investment. And for whatever reason, many people think about, a 2 or 3 year time horizon. This is one where you're saying to get the maximum benefit, you got to be prepared to sit this out 10 years. Now, I don't really have a problem with that. I mean, knowing that, that's a part of your portfolio that you would set aside for this. But I would say that's just a caution, and people have to understand in any syndication, their investment is not liquid. It's a private enterprise, and you're putting in the money, which is the fuel to make the project go. And as soon as the project pulls the trigger, that money's deployed. You can't come like you could in the stock market or in precious metals 6 months later and say, I really need to get my money back. It doesn't work that way here, especially because you have this additional layer of these tax benefits that are driven by the calendar.
Right. No, that's a great point. I actually had not thought of that, but it did remind me of another kind of point that is probably it is bad or ugly, which is when you have an opportunity fund that has multiple, or even if it has one asset, but let's just say you have a fund that has 3 or 4 properties and it decides to sell one of the properties and then reinvest that into another property in a different opportunity zone. And it sounds from the regulations that came out that even though the investor doesn't get the capital gains because they've invested in the fund and they haven't sold their fund, right? They're still in the fund.
They still have the investment.
The fund has a capital gains from the sale, and that gets passed on to the limited partners. So you do have that tax break, that tax gain if you're buying and selling within the fund, which isn't the end of the world because it's only a portion of the portfolio, but there is a tax hit if the fund is buying and selling, at least as it stands right now.
Yeah, and that would be a consideration for a manager, right? I mean, I'm kind of okay with that because there's this whole mindset of managers, not necessarily real estate syndicators, but folks that manage funds who create transactions just because they make fees and stuff So, a lot of brokers who do syndication get paid a brokerage fee. And as you've taught us, as long as they disclose that and they're licensed to receive it, perfectly fine to do that if everyone's like, of course, we need to use an agent and you're the agent or broker we're going to use. But you can see where a broker might be tempted to say, well, we got to buy and sell a few things, but this could limit that. Now, you mentioned different opportunity zones. So is it fine for a fund to invest in different places, different states across the U.S.?
Yeah, there's no, yeah. So as long as 90% of their assets is in an opportunity zone, you're fine. So if you wanted to have multiple properties and you want to sell one and buy another one in that zone, or you want to have one zone in Manhattan, which, as you know, has opportunity zones, or one in Detroit, then that's fine as well.
Well, that's part of the thing people have to understand is that a lot of the physical areas inside these opportunity zones are the parts of town you usually don't go in. They're the places that need help. But it's not 100% like that.
Right.
Again, the process happened, and it's been going on for a long time, is that the governor of each state put together kind of a task force to go figure out, and that was a big job. And of course, today there's an interactive map, and we'll tell you how you can get access to that so you can see where these areas are. But I think the reality check is if you know an area well, you're going to be able to look at the map and go, yep, that totally makes sense. That's an area of town that needs help. Yep. I get it. I think it's the people that don't know the area well that go, oh, look at all the pickings there are.
Right.
You just got to be careful because these are areas that are a heavy lift for anybody raising money.
Yeah, that's a great point, Robert. And one of the things I've already been reading about is that not all opportunity zones are created equal. there are some zones that people are arguing aren't really in need of the economic or not as needed as other places. So there are places in Oakland, for example, in California that need some help, but they're pretty good neighborhood. Manhattan's the other example. I mean, Manhattan, I haven't visited the opportunity zone in Manhattan, but it's Manhattan. How bad can Manhattan be, right? So there's definitely some zones that are better than others, and that's been one of the criticisms that there seems to be. This is like 9,000 opportunity zones, and there's quite a few apparently that are in need of help, but not as much as you would think. So that's another concern that they have. The other uncertainty that we have, and maybe this is another bad or ugly, is we don't know right now how the states are going to respond. Some of them we do. So some states have already, and they're in different stages of development. So some people have introduced bills, some people are actually passed the bills and they've gone to the governor. But each state obviously has the right to either copy this law and do the same kind of deferment for the state taxes, but they're not required to. So you may end up still having a capital gains at the state level if you live in, where I live, for example, California. I wouldn't be surprised that you still have to pay the California taxes on the gains.
All right, that's a good point. And also, if you live in a place that's different than the place you invest, that's just one more thing to talk about with your tax professional. Now, Mauricio has taken upon himself, and we're super excited about this, to put together a lot of this information in a brand new report. In fact, when we were talking a few months ago, you said, I'm really working on a report. As soon as this stuff comes out, I want to have the latest and greatest information. So tell us what's in the report.
It's basically, the good, the bad, the ugly, but obviously a lot more detail. There's a lot more good, bad, and ugly. And then I also go into the business side. And again, there's some investors obviously are interested in purchasing businesses or starting a startup and, go to the opportunity zone to get the benefits. So I'll go into the good, the bad, the ugly on the real estate side, but also on the business side.
All right. When we come back, we'll tell you how you can get a copy of that report. Also, you'll be joining us for the Secrets of Successful Syndication coming up. Always good to have you educate folks about the legal side of raising money. That's always a fun event.
Yeah, I'm always a blast to do it and looking forward to it in September, right?
In September. All the details on the website at realestateguysradio.com under events. Well, attorney Mauricio Rauld, thanks as always for the effort you put in not only to the show, but to creating the report. It's good to see you.
No, thank you and appreciate being on the show.
More when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Hi, this is Patrick Donahoe, CEO of Paradigm Life. Wall Street and banks spend billions of dollars per year in advertising with the goal to convince you that they are the solution. But take a look around. None of their advice has worked. If you're listening to this, odds are pretty good that you're already a real estate investor, or at least becoming one. So why do you do it? Is it to hedge inflation, the tax benefits, or maybe it's to get your money away from Wall Street? It's because of these benefits and so many more that I created the Real Estate Investor's Guide to the Perpetual Wealth Strategy. When you combine successful real estate investing with the Perpetual Wealth Strategy, you have the recipe for what has helped the wealthy to establish their financial well-being for decades. You can download the Real Estate Investor's Guide to the Perpetual Wealth Strategy today by clicking the Resources tab on the Real Estate Guys Radio homepage. Don't wait, go download it now.
Are you looking to create sustainable wealth through agricultural real estate? Then look no further than Agro Nosotros. They're a sustainable specialty agriculture company with specialty coffee farming operations in Panama and fine flavor organic chocolate operations in Belize. Over the last 4 years, they've helped ordinary people to diversify outside of traditional real estate and into offshore agricultural real estate. They don't have your typical tenants, termites, and troubles. Their tenants are trees, and they grow and produce two hugely popular and proven products, coffee and chocolate. Through Agro Nosotros, you can own half-acre parcels in your very own specialty coffee or organic cacao farm, turnkey managed on your behalf, that produce passive cash flow for you and your heirs. And you can feel good about where you put your money to work. Agro Nosotros has socially sustainable programs that provide living wages, improved accommodations, and a steady channel to market to literally hundreds of farmers. And so far, they've placed 61 kids in school. To find out more and see how you can get involved, email agro@realestateguysradio.com. That's agro, A-G-R-O, @realestateguysradio.com.
Hey, it's Kyle Wilson, Jim Run's 18-year business partner, and you're listening to The Real Estate Guys.
And welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. If you want to come out and meet the Real Estate Guys at an upcoming event, all you have to do is go to the website at realestateguysradio.com and click the tab that says, are you ready for it? Events. And there's a bunch of events that we do and a bunch of events that other folks do that they invite us to come and be part of. And it's always fun to get out and meet folks. We'd love to meet you at an event. We're talking today about opportunity zones. Great to hear from Mauricio Rauld.
Yeah, so there was a couple things that came up there. And one thing I would like to comment on right away, because I know we don't have a bunch of time, but the concern that a bunch of money is going to flood in, bid the price up.
Right.
And see, that's the inflow, that's the tide, the rising tide. And the big concern is when the tide goes out. But if you think about the way this thing works, it's designed to hold the money for a decade.
Yeah.
So the big incentive is to put the money to work and leave it there. And so sometimes you worry when there's a temporary incentive. We had this with the GO zones back in the day, and there was a 1-year accelerated depreciation. You go in, you get a 50% pop. You get to write off half the property the first year, and then you've shot your wad, right? Then you're done. And then do you exit the property? And so I don't know that there was a lot of as much thought put into this. This, from what I can tell, and of course it remains to be seen, it all looks good. Every play is designed to go for a touchdown on the chalkboard. But then you run it in the real world and you see how the players play. So it's going to be really interesting to see how investors react to this. But on the chalkboard, it looks like it's designed to prevent the speculation, the get in, the get out, the rapid trading. And go figure. I mean, it came out of a Trump administration, and Trump's a real estate guy. He's a developer. He deploys capital for long periods of time. And he is in New York, and we toured some of that stuff when we were driving around New York City with George Ross. And he was pointing out these different buildings that Trump had renovated. And these are major long-term renovation projects that literally changed entire sections of the communities where they were in. And I just think it's that same formula, except instead of just one section of Manhattan, it's the entire United States of America and Puerto Rico.
Well, and as George pointed out to us many times, if not every time, there was some big tax benefit. There were all kinds of sometimes negotiated tax deals that made it better for investors. And this is an opportunity, I think, for people to consider what they're investing in and why. If you've been a stock investor forever and you just like equities and you follow companies, we're not saying don't do that. But if you have that one stock that you bought a long time ago and it's got a huge gain in it, well, maybe this is the opportunity for you to be able to defer that at the very least. And if the investment makes money, make a return tax-free.
Well, and for people who feel like they've been trapped in paper for a long time, maybe they read Robert Kiyosaki's prophecy and they go, hey, you know what? I'm a little bit concerned that the demographics here, the paper market might take a turn. And yeah, they're printing a bunch of money and the financialization, but it's really a move, a shift, if you will, from making money by trading money to making money by building things that are real, that serve communities. I mean, obviously, we're real estate guys. We're slanted. We think it's a better way to go. This is a different form of a public-private partnership. Tom Wheelwright says all the time, the government is your partner through the tax code. This is an example of that. And of course, it's true on the other side of the coin when people want to use the tax code to redistribute. It's also a public-private partnership, if you will. It's just organized centrally instead of at the street level. So these are just two different ways to approach the problem of moving money where it needs to go. And I think that, ultimately it's going to entice money that's not normally been in the space of real estate to move into the space or take a good hard look at it. So, as purveyors, people who are out there putting deals together, this is a super, super exciting time. You take the Jobs Act and the ability to go solicit accredited investors, and you combine it with the Opportunity Zone, which is really giving you a compelling story to talk about in your asset class. You put those two things together and go out in the marketplace. It's a big reason why we're so excited about the concept of syndication. I know people get tired. Well, guys, you guys always talking about syndication. It's the biggest opportunity in real estate right now. Everybody that's ever made it huge in real estate does it through syndication. And the saddest thing is you watch people going to these no money down seminars and how do I do these little tiny deals? And, And yeah, you got to do some stuff to learn what you're doing and build some relationships. But ultimately, if you want to go bigger, faster, you're going to do it through syndication. In my estimation, of course, it's just my opinion, there's never been a better time to do it than right now.
Absolutely. And hey, if you want to see Mauricio's work and get that report, it's pretty simple. All you have to do is send an email to opportunityzones@realestateguysradio.com, opportunityzones@realestateguysradio.com. That's the same email address we used on the last show where we talked about opportunity zones, and it's going to include the same links, which are places you can go read the IRS code and a link to the...
That sounds fun.
And it's not that much. It's not just actually the code. It's a great, actually a well-done page that the IRS has put out about the frequently asked questions and opportunity zones, and access to the interactive map, which people have a fun time with, looking at areas that they know and areas that they grew up and places that they visit and see where the opportunities are. There's a lot. So many. Plus, Mauricio's report. All you have to do is send an email to opportunityzones@realestateguysradio.com. And at the Secrets of Successful Syndication in September, we'll do a whole segment on this. So if you're thinking, hey, this could be a great opportunity for me to invest some appreciated asset gains, but also maybe I could form one of these opportunity zone funds. We'll talk about exactly how you do that at the event. All the details at realestateguysradio.com under events. Big thanks to Mauricio Rauld for sharing his ideas and information with us today and putting together that great report. Until next week, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.